So picture this. A company makes a monumental decision to sell off a huge piece of its empire. We could be talking about a flagship factory, an entire product line, or maybe all of its operations in another country. It's a massive strategic move, one that's going to completely change the company's future.
But how does a huge decision like that actually get reflected in the numbers? What happens on the balance sheet and the income statement? It's definitely not as simple as just waiting for the money to roll in. Oh no, there are very specific rules for this.
And that's where this special accounting rulebook comes in. It's called International Financial Reporting Standard 5, or IFRS 5. And it's basically designed to make sure that when a company is planning a major sale, it tells that story clearly and honestly in its financial reports. So you ready? Let's dive in. We're going to follow the entire life cycle of one of these assets. We'll start right at the beginning, the moment the decision to sell is made. Then we'll see how it gets tested and measured, how it pops up on the financial statements, and what happens if the company gets cold feet and changes its mind. Okay, first up, the big shift in mindset. The second a company officially decides to sell a major asset, the whole way accountants think about that asset just flips. Its value isn't about the profits it's generating anymore. It's all about what it can fetch in a sale. And this right here is the core definition from IFRS 5. It sounds pretty straightforward, but this one little sentence triggers a whole cascade of accounting changes. The asset basically stops being part of the long-term operational machinery and becomes, for all intents and purposes, inventory that's just waiting to be sold. But here's the thing. A company can't just casually say, we might sell this factory someday, and then go changing its accounting. Nope. IFRS 5 sets a really high bar. The plan to sell has to be real, it has to be serious, and it has to be happening, now. And this is how they prove it's serious. The standard uses the term highly probable, and to meet that, you have to tick all 5 of these boxes. Management needs to be fully committed with a formal plan. The asset has to be available for sale right now, as is. You need to be actively out there trying to find a buyer at a realistic price. And the whole deal is expected to be wrapped up within 1 year. All right, so once an asset passes that tough test and gets officially classified as held for sale, the next big question is, what's it worth? Because this classification completely changes how we measure its value on paper. So now we have 2 numbers we have to look at. On one hand, there's the carrying amount. That's the asset's value on the books right now, its original cost minus all the depreciation. And on the other hand, you've got its fair value less cost to sell. Think of that as its market price, minus any fees like broker commissions. And this is the absolute key. The standard says you must record the asset at the lower of those 2 values. It's a rule of caution, really. And for an investor, this is so important because it prevents companies from getting too optimistic and inflating their asset values. If the sale is going to lead to a loss, that loss has to be recognized now, not buried until the deal is finalized. And boom, here's another huge change. The very moment an asset is classified as held for sale, depreciation just stops. Cold. Why? Well, think about it. Depreciation is all about spreading an asset's cost over its useful life, but its useful life with this company is basically over. Its value is now all about its sale price, not its ongoing use. Okay, so we've changed the classification, we've changed the measurement. How does all this actually show up in the financial reports that investors and everyone else sees? This is where it's all about transparency. On the balance sheet, these assets get pulled out from the usual property, plant, and equipment section and get their own special spot, a separate line item called assets held for sale. And if there are any liabilities directly tied to them, they get their own line too. This separation acts like a giant flashing sign, telling everybody, hey, a big part of the company is up for grabs. Now, if the thing being sold is really, really big, like a whole line of business or all of your operations in an entire country, it gets an even more special label, a discontinued operation. This signals a huge strategic shift. And for anyone reading the financials, seeing this label is a total game changer, especially because of how it messes with the income statement. To really see what I mean, just look at this super simple income statement for, let's call it Explainer Corp. Before the sale, all the revenue and expenses from every part of the business are just mushed together. It's kind of hard to tell what's part of the core business and what's about to be sold off. And here's the after. See that? All the financial results from the part of the business being sold are yanked out of the main revenue and expenses. They're collapsed into just a single line, loss from discontinued operations. This gives investors a crystal clear picture of how the core, ongoing business, the part they're actually invested in, is really performing.
But, life happens. Not every planned sale actually goes through. The market might take a dive, the perfect buyer could back out, or management might just have a complete change of heart. And IFRS 5 is ready for that. So what happens if the whole deal collapses? You can't just flip a switch and pretend it never happened. There's a very specific process for unwinding that held-for-sale classification.
If the plan gets canceled, the asset has to be remeasured all over again. The rule is you have to value it at the lower of two numbers, what it's worth today, or what its book value would have been if you'd never stopped depreciating it in the first place. This clever rule stops a company from booking some kind of artificial gain just because a sale fell through. After that, it moves back to its old home on the balance sheet, and depreciation starts right back up again.
So, when you boil it all down, IFRS 5 isn't just some dusty accounting rule. It's really a standard about clarity and, well, honesty. It forces companies to be transparent about their biggest strategic decisions, preventing them from hiding bad assets or misleading investors about where the business is headed.
And you can see that right from the very first paragraph of the standard itself. Its whole purpose is to lay out the rules for accounting, presentation, and disclosure. It's all about making sure the story the financial statements tell is the true story.
So now, hopefully, you have the tools to really understand that story. The next time you see that assets held for sale line on a company's report, you'll know about the strict tests it had to pass and exactly what that means for the numbers. And it lets you ask the really important question. Is this company shrinking just to survive? Or are they making a smart move, selling off the old to build something new and better? The answer, as always, is hidden in the numbers.